So today we're going to talk understanding debt to income ratio, what it means for your home purchase. You know what drives me crazy? When someone gets turned down for a mortgage and they have no idea why. They've got money in the bank, steady income, but somehow they don't qualify. Nine times out of 10, the culprit is something called debt to income ratio. And here's the thing most people have never heard of until it becomes a problem. I'm Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. So what exactly is this debt to income ratio and why should you care about it? Think of it this way. Your debt to income ratio, we call it DTI in the industry, is simply all your monthly debt payments divided by your gross monthly income. That's it. Lenders use this number to figure out if you can handle the monthly payments on the loan you're asking for. Let me give you a real example. Say you're paying $1,500 a month for your current mortgage, another $100 for a car payment, $400 for credit cards and other debts. That's $2,000 total going out each month. If your gross monthly income is $6,000, your DTI is 33%. You take that $2,000, divide it by $6,000, and boom, there's your ratio. Now, here's why lenders care so much about this number. Studies show that borrowers with higher debt-to-income ratios are more likely to struggle making their monthly payments. Makes sense, right? The more your income that's already spoken for, the less cushion you have when life throws you a curveball. What's a good DTI? A good target is below 36, but, and this is important, you can qualify for a mortgage with a higher DTI. The exact requirement varies by lender and the type of mortgage you're going after. Here's what most people don't realize, though. Your DTI doesn't tell the whole story about what you can actually afford. It doesn't account for groceries, utilities, gas, insurance, entertainment, and all those things that come out of your paycheck every month. And remember, DTI is calculated using your gross income, not your take-home pay after taxes. So just because a lender says you qualify doesn't mean you should max out that what you're willing to give you. It doesn't mean you should max out what they're willing to give you. What if your DTI is too high? If you're sitting at 50% or higher, you've got some work to do before you're ready to buy a home. The good news, there are steps you can take. First, pay down debt. Focus on knocking out the smaller balances. Here's a little secret. Most lenders won't count installment debts like car or student loans if you only got a few months of payments left. Second, avoid taking on new debt. I can't tell you how many times I've seen deals fall apart because someone went out and bought new furniture on credit card right before closing. Third, if your DTI is really high, it might make sense to wait. I know that's not what you want to hear, but sometimes the smartest move is to get your financial house in order first. That's why we have Key Steps, rsrlinks.com/keysteps. So what does this mean for you? The lower your debt to income ratio, the safer you look to lenders, and that means better rates and better terms. More importantly, it means you're setting yourself up for success as a homeowner. This is where strategic debt management comes in. Instead of just looking at individual interest rates, we look at your household blended interest rate. We look at how much money is actually coming out of your household budget each month because strategy beats rate always. If you want to see where you stand and explore strategies to improve your debt to income ratio, head over to rsrlinks.com/keysteps. rsrlinks.com/keysteps. That's our financial house in order tool. And it'll help you understand exactly where you are and what steps to take next. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. That's the Mortgage 101 segment brought to you by GetHomeselect.com.